We've all made rookie mistakes in the markets once in a while. Even some of the greats like Warren Buffett or Benjamin Graham have made their fair share of blunders. But don't worry, through their mistakes and some of our own, we are going to be breaking down in today's video the 5 biggest things to not do in the stock market.
Hey, everybody! Listen up!
Whether you're a seasoned pro or just starting out, make sure to pay attention to these tips. And hopefully after this, I can help you avoid some of the big heartaches and headaches that you might have otherwise experienced. And hey, if all else fails, just channel your inner Jordan Belfort and party like it's the 90s. And the first and foremost is something that we've probably all been guilty of, and that is chasing the hot stocks.
Oh, that's hot. That's hot.
Usually this happens because it can be extremely tempting to chase what's being talked about and what seemingly doesn't have an end to its rally, right? But this can be actually one of the most risky strategies of them all. Just ask anyone that invested into GameStop or AMC during the Reddit market bubble, or anyone that bought into the Dogecoin craze right before the Elon Musk SNL skit. A lot of those people either stopped investing or just started buying indexes because they were so scared to lose more money. That is why it is so important to do thorough research into a stock or an investment and to consider the company as a long-term play and not just the short-term frenzy or the hype. An example of a hot stock that was trending for a long time and right now is going downhill is Tesla. The stock price is still up thousands of % over the last 10, 15 years. And while Tesla has been a pretty successful company over those years, it's still good to keep in mind that a lot of the investors that invested in it did it because they wanted to ride the hype train. Well, not like that. Now, you've probably heard this a million times, but it's very likely that you don't do this enough, and that is not diversifying in your portfolio. Diversifying your portfolio is important because essentially you're putting eggs in different baskets. So if someone breaks one basket, you're fine because you have eggs in other baskets. This could mean diversifying into different asset classes, different industries, geographic locations, all sorts of different ways to diversify. And the way I like to think about it is imagine you have a bunch of children and the whole point of having those children is in the hopes that just one of them becomes the next Elon Musk. Maybe that's not the best analogy, but it makes sense, right? Diversification in different markets has a very critical role to play in the amount of wealth that you make and keep. Imagine if you didn't diversify and just invested all your money into Apple. Over the long term, you'd actually do pretty okay. But because Apple is the largest public company on the market today, that doesn't mean that it's gonna hold that position there forever. And if for the next 10 years, it actually underperforms to companies like Samsung, Intel, Tesla, that would mean bad news bears for your portfolio, or at least what you could have earned versus what you're earning by just holding Apple stock. Now, I could go on for hours on end about diversification, how you can do it properly, but instead of doing that all in this video, I have another video that you could watch after this one's up. I'll link it at the end. After watching that video, you'll become a master at diversification, I promise you. But next, we have a very dangerous and risky behavior, and that is not having a clear investment plan. It's always important to have a clear and concise investment strategy that aligns with both your risk tolerance and your financial long-term goals. This should include things like having a diversified strategy, a timeline or horizon for how long you want to stay invested in a particular investment, and a strategy on how to rebalance your portfolio if the time comes. And an example of not having a clear investment strategy might be something like just YOLOing into GameStop or AMC stock. Remember that it's really important to have an investment strategy, but make sure to stick to it, because a lot of times what can happen is you might hear your neighbor or your colleague talking about some great new investment, and when you do your risk management of that investment, you realize, oh, this is a piece of crap.
It's the biggest piece of dog shit.
That is when you don't buy it. But a lot of times what happens is we hear about it, but rather than looking at this investment and realizing that it's a piece of crap, you get that little bit of FOMO in your heart and you decide to go against your rules and invest anyway, and that is how some of the biggest losses are made. So have an investment strategy, stick to it, and most importantly, check back on it to make sure it still aligns with your investment horizon. Number 4 is getting caught in the market hype. Now, I know we talked about chasing hot stocks this is kind of the same thing, but it's a little bit different. The stock market or crypto market can be extremely volatile, and it's important to stay grounded and avoid the short-term fluctuations of it all. And I'm gonna use Tesla for the same example because a lot of people do invest into Tesla because of the hype that the company is doing and all the things that they're up to, the energy, the robots, self-driving, and most importantly, the fact that it's run by a super genius named which is why it's so important to actually look at the fundamentals of the business, aka the recently quarterly report or the yearly report, how much debt they have, how profitable they are, and overall just try to stay away from these hype investments, right? Because the same guy that invested into Bitcoin at the peak market is now the same guy that's working at McDonald's because he thought Bitcoin was gonna go to the moon. I'm not saying that I don't believe in Bitcoin. I'm just saying that a lot of these hype investments are most talked about when it's the best time to sell. So try to keep that in mind the next time you hear your neighbor talking about the greatest investment opportunity. Now on to point number 5, and that is avoiding risk, or lack thereof actually. And here's why. A lot of people, when they see a high risk, high reward opportunity, they take it. What that might be is something like a penny stock or an NFT or a cryptocurrency that has an animal on its token. Those things could be fine to invest in as long as you've done the proper risk assessment and know when to get in and get out. But if you do happen to invest in that and don't do the proper due diligence, you'll probably end up homeless. At least if you throw all your eggs into that basket. Okay, maybe homelessness is a little bit dramatic, but let's just say it doesn't end well for your portfolio either way. Which is why it's so important to understand and manage risk when investing in the markets. There are so many factors to consider when it comes to risk, such as the profitability of a company, its trajectory, management risks, dilution risk, shareholder buy or sell pressures, and so many more. In fact, people literally make careers out of just studying this stuff. Now, if you want to avoid these risks and be more up to date as to what's happening in the markets, make sure to subscribe to this channel. And more importantly, let me know that you want to see more videos like this by commenting what you want to see in future episodes down in the comment section below. Remember, I have nothing to sell you, no courses, no seminars. I'm just here to make you more knowledgeable and richer than you were yesterday. And lastly, don't forget that even the most knowledgeable traders and investors make mistakes from time to time. So don't be hard on yourself. And if you want to see exactly how to properly diversify, go check out this video here. Thank you all so much for watching. I'll catch you guys in the next one. Peace out.